Hello, I'm Annabel Brodie-Smith, Communications Director of the Association of Investment Companies. As we endure another lockdown and concerns about the economic impact of the pandemic increase, providing investment and advice to young, innovative British companies has arguably never been more important. This is what venture capital trusts, known as VCTs, do. They support innovative businesses which provide vital social and economic benefits. Since their inception, VCTs have generated over 1.4 billion of exports and created tens of thousands of jobs. But what is the outlook for the sector? And how can VCT investment help young British businesses survive and thrive during the pandemic and beyond? Today, I'm delighted to be joined by three VCT investment company managers. Stuart Veale, Managing Partner at Beringier, who managed the proven VCTs. Warren Rogers, Head of Downing Ventures and Partner at Downing, who managed the Downing VCTs. And David Hall, Managing Director at YFM Equity Partners, who managed the British Smaller Companies VCTs. Right. On to the questions. What impact has the pandemic and subsequent lockdowns had on your portfolio? And I'd like to ask that question to Stuart.
Well, going into the pandemic last March, nearly all the companies in our portfolio faced a similar set of challenges. The main ones were moving everyone to working from home, the uncertain economic environment that they were heading into, and how to access government support schemes, such as the furlough scheme and the CBILS loans. I have to say we were really impressed by the way our portfolio companies responded, which says a lot for the quality of the management teams. And we, as the manager, also provided a lot of support to our portfolio companies. We organised multiple webinars for chief executives and other C-level executives on topics which ranged from remote leadership to how to access government support schemes. One of the most important things each portfolio company did was to produce a new COVID business plan, which took account of the potential negative impact on revenues and identified potential cost savings. This was something which we as the fund manager insisted on. Our investment team worked very closely with each portfolio company to produce an appropriate plan. And then, together with company management, we monitored performance against the plan and made adjustments as necessary. As a result, many portfolio companies persuaded employees to take a temporary pay cut, typically of 20%, or put people on a 4-day week, or put some people on furlough. And this enabled nearly all portfolio companies to trade through the worst impacts of the pandemic without needing to raise additional funding.
Thanks very much, Stuart. I'd like to ask the same question on the impact of the pandemic to Warren.
Thank you. When the pandemic started, much of our portfolio found itself right in the thick of things. Many of them saw their businesses grow exponentially during this unprecedented time. Across our healthcare portfolio, companies such as Touchlight have been critical components in developing the vaccine with their revolutionizing DNA technology. Within our enterprise portfolio sit some of the very best edtech companies in the world, such as EdPlace, who have made the transition to home learning a bit easier for teachers, parents, and children. Behind the scenes of all of this are our deep tech companies such as Cornelis Networks, whose technologies are being used to enable huge amounts of data to be processed for COVID-19 research, working alongside the likes of the US government, the UK government, and other agencies. In all this chaos and sadness, we're proud to see our portfolio rise up to the challenges of this pandemic and in their own ways have succeeded.
Thanks very much, Warren. I have to say that education technology has been absolutely vital for working parents with the homeschooling nightmares that we've had to endure. On to you, David. What impact has the pandemic had on your portfolio?
Yeah, your comments about homeschooling, I think, resonate with one of the things for the portfolio, because in a way, it was a very human scale response. I think the relationship with the portfolio businesses has changed. I think part of that is the fact that you're now dealing with people in a slightly different environment. It is over the medium of Zoom, but effectively the fact that for a lot of people that home and work have merged has changed, I think, some relationships. And I think the way that the portfolios responded, very similar to what Stuart said, there was an internal look, but also I think each of the businesses sort of reset its relationships with its customer base and its suppliers. And as they understood how they were going to continue trading with each other, I think kind of new and strengthened bonds have emerged. The result of which is clearly venture capital trusts invest significantly in businesses which are young, emerging, growing, and also drawn to sectors like data, technology, management, media, and telecoms. And those sectors have all seen accelerating growth. So the result of that has been those sort of new and stronger bonds that have formed have seen accelerated and improved trading performances and growth, perhaps in areas that you wouldn't otherwise have seen. And that sort of having lived 5 years in one, which is a phrase that I think we've heard quite a lot over the last year, has actually seen people take a big leap forward at doing it together. And that's how the portfolios have responded. So there was an initial sort of shock, understanding what that impact was for them, and then move on to sort of go and develop. It doesn't mean that everybody is in that position, but the strong have got a lot stronger.
Thanks very much, David. I have to say 5 years in one in terms of trends. I feel like a lot of people, especially those parents at home working, felt like they did 5 years in one last year. But, it's good to hear there is a positive side to that too. I'd like to ask, what implications does the recent Brexit deal have on your investee companies? And I'd like to ask that question to Warren.
Thank you. Well, thankfully, we've seen a limited impact due to Brexit. However, we're conscious that there are bound to be a variety of unintended consequences that we need to give a lot of caution to. The UK has been working hard to build an innovation economy for many years. Despite this, interestingly, the UK government is considerably underinvested in the innovation sector as much as some of our former EU members. After this divorce, it remains unclear if many of the EU agencies and organizations that have supported some of our portfolio and others will continue to fill the void that it seems the US government has yet to prepare for.
Thanks, Warren. David, what implications has Brexit had on your portfolio?
I think it's depended upon what the trading position of those portfolio businesses are. So businesses which are physically moving goods across borders have had a very different impact to businesses where they are just trading service-based businesses. So the ones that are physically moving goods across borders have had to adapt trading and supply chains in a way, for example, like investing on mainland Europe in some places. So there's been a more friction, I think, in the very short term, and particularly with a lack of clarity in some cases over exactly how goods should or shouldn't move. They tend to be a much smaller proportion overall of venture capital trust portfolios, as they are of ours, and I think of others here. For those businesses as well, which are service-based businesses, there's definitely been a movement of people over time. And what we've seen, particularly in financial services, we have seen a little bit of relocation of UK-based jobs onto mainland Europe in the short term. I think that's just to enable them to be able to continue to trade. Hopefully future growth will see more UK-based growth come out of it as well. So I think those are at the micro levels, what we've seen as the impact. I think the more, the medium term, I think will depend upon how the UK responds to the larger regulatory issues like the movement of state aid and how that frees up further investment into UK economies. And I think that's something that we really want to look out for the end of 2021 and then going into 2022 next year.
Thanks very much, David. Clearly, there are long-term implications of this. Stuart, what implications does the recent Brexit deal have on your invested companies?
Yes, Annabelle, I think virtually every company in the portfolio is going to have to adapt to the new environment post-Brexit to a greater or lesser extent. The great thing is that early stage companies run by entrepreneurs are great at adapting. So if you throw up a challenge, they'll find a way of dealing with it. Like David, it's different depending on the type of business. But what we've seen, for example, for companies dealing in physical goods, for companies which were previously importing some of their supplies from overseas, they've had to restructure their supply lines and shorten them so that they're now sourcing products primarily from UK companies. And then on the other hand, businesses which were previously supplying Europe out of the UK have had to set up or enlarge their European operations so that all EU customers can be serviced from the EU without having to transport goods across borders. So that's just a couple of examples of adaptations for companies dealing in physical goods. I think for businesses which are more knowledge intensive, developing software and other business-to-business tech-enabled services, one of the challenges is going to be access to talent. Those businesses have historically relied a lot on very talented people coming from EU companies and being able to work in the UK. And that's clearly going to be more difficult. So I think over time, again, we'll see adaptation, possibly with those businesses setting up hubs in Europe where EU nationals can work. Because clearly, if you're working in a tech business, you don't all need to be physically gathered in the same place. You can work remotely. So I think we'll see a transfer of some of those knowledge-intensive jobs to the EU to address that potential shortage here.
That makes a lot of sense. And obviously, we've all adapted to remote working now. David, I'd like to ask you, how do you approach ESG when you work with your portfolio companies?
Thanks, Annabelle. I mean, ESG is a core part, I think, of investment activity. And it's expanded in terms of its terminology. I mean, we use the phrase impact, and we're encouraging businesses to make positive impacts across a range of areas. So ESG is a lot more now than than just the impact on the environment. It's about your community, your corporate culture. And we look at it very much as over the period of time that we are invested with a business, which can be typically 4, 5, 6 or 7 years, that at the end of that stewardship, the business is a better business. And that is not just in financial return, but in lots of those other areas. And there are lots of tools that we use to help and encourage that. But from the outset, as part of the assessment of the business, we'll agree in the initial project some goals that they want to set themselves and objectives. And then we set specific things to measure that, whether that's about increasing employee engagement or running apprenticeship schemes, or how they want to improve their relationship with local schools. Whatever it is, we'll set those as initial goals, and then they will be continually reviewed by the management teams in which we invest as we stay. So it's one of those areas which is a sort of truth, isn't it? What gets measured gets managed, and what gets managed gets done. So I think if that's in the heart of the sort of the KPIs that businesses use, right, will mean that ESG and all of its positive outputs, can be seen and taken on by all businesses. And in some businesses, even if they just do one thing better than they did when they started, that sometimes can be like a real win.
Thanks very much, David. I think investors find it really reassuring that you're monitoring these ESG benefits and measuring them and seeing an output. I'd like to ask the same question to Stuart. ESG and the benefits, how you're working with your companies.
Yeah, sure. I mean, ESG is really right up at the top of the agenda now. It's really important both to VCT fund managers and their underlying investors and the companies that we invest in, that they really focus on ESG initiatives as an issue. Companies who want to recruit employees, those employees will only want to join businesses which share their values. And the same thing for customers. We'll want to buy products from companies that share their values. So things like sustainability and packaging, for example, are getting increasingly important in companies building their brands and attracting customers and growing their revenues. So we're taking this very seriously at Beringia, and we've taken a lot of initiatives internally in terms of training and recruitment, and also in the places that we look for deals to make sure that we get access to underrepresented founders. And we're also organising lots of things for the portfolio, for example, webinars on sustainability and unconscious bias. And we're encouraging companies to collect diversity metrics and take actions to improve diversity, not least at board level. And we're also developing a framework alongside our portfolio company's social value portal to evaluate the social impact of existing and new portfolio companies. And it's also important to say that the increasing focus on ESG across the population is creating investment opportunities. And 4 out of the 5 companies that we invested in for the first time last year are all benefiting from this trend. So we invested in Second Nature, which provides a sustainable weight loss program through their app. Commonplace, which allows communities to influence their built environment. Social Value Portal, which allows organisations to measure and manage the social value that they create. And Luxury Promise, which has got very strong sustainability credentials as it's based on recycling pre-owned luxury products.
Thanks very much, Stuart. I think I might be using that one myself. I think I've got quite a number of second-hand handbags, for example, things like that here, which I really ought to be selling. So it does sound very sustainable and extremely useful as well. I'd like to ask the same question to Warren.
Yeah, thank you very much for that. I think it's an interesting area that we put a lot of thought into. Downing is a signatory to the Principles of Responsible Investment, a UN-supported network of investors committed to ESG. Downing takes its ESG responsibilities very seriously. We have a variety of checks and systems in place that let us screen investments as part of our selection process. With the responsible investor approach, we apply the same standards to our investments, and we'll always ask the wider question of how a portfolio company is positively and responsibly providing a solution to its wider network and the world around it. We were very fortunate to be an investor in a company called Parsable, which is a perfect example of this. They have digitized operational tools for today's frontline industrial workers, men and women working in sometimes dangerous manufacturing environments, all through COVID. It's like the unsung heroes. People that didn't have any choice but to go to work in consumer packaging, food production, other facilities that are critical to our day-to-day lives, all in the midst of COVID. If they didn't go to work, there would be no food delivered to their grocery stores. The Parsable platform, their connected worker platform, takes standard operating procedures and safety procedures, digitizes them, puts them on your mobile phone or another handheld device to ensure complicity with a variety of safety and operational standards. It's an international platform that's had huge uptake in the COVID environment, which was already growing before. It's one of the big, the law of big numbers arguments we make here at Downing, that any investment we make has to be a global proposition. Other things that we've done is, we have an investment in a company called Vivacity, which is making urban environments safer and less polluted by the way it monitors and optimizes traffic flow. There's Carbice that makes electronics safer with their Carbice carbon product by reducing heat. But in all of this, part of our screening, we look for diversity, inclusion, good policies that provide a workforce that, shows, the people who are really in the world, not just sort of a one-way street. So we like to look at a variety of factors there, but it's very serious to us here at Downing.
Thanks very much, Warren. I have to say diversity and inclusion is something that I'm passionate about. It's very good to hear a number of you talking about that. Next question. What is your outlook for VCTs and where are you seeing opportunities? And I'd like to ask that to Stuart.
Sure. Thanks, Annabelle. Well, I'll highlight 3 areas that I think there are going to be great opportunities for investment. The first one is the circular economy, which includes consumers recycling pre-owned products. It's a very sustainable model. And one of the themes we're seeing is companies improving sustainability and recycling items which people no longer need. We've already had considerable success in this area with Watchfinder, which is an online retailer of pre-owned luxury watches, which we sold a couple of years ago, generating a high multiple of return on our investment. And more recently, we've made investments in MPB, which is a website enabling the buying and selling of used camera equipment, and Luxury Promise, which I referred to before, which does do the same for pre-owned luxury handbags. A second area I'd highlight is maximizing the value of data. The volume of data created and consumed worldwide is estimated to have grown fourfold between 2015 and 2020, and it's expected to continue to grow exponentially. And this is going to create a lot of investment opportunities as businesses try to work out what data they have and then try to analyze and present it in ways which enable them to create value. Some of the companies in our portfolio which take advantage of this trend include Edited, which collects data so it can provide market intelligence to online retailers, Contact Engine, which supports companies with automated interactions with their clients to make them more efficient, and Exonar, a data discovery company. And the third area we think is really interesting at the moment is improving societal outcomes. As I mentioned last year, several of the investments we made last year fall into this category. So those are probably three of the key areas that I would pick on at the moment in terms of areas that we think are interesting to pursue for new investments.
Thanks very much. It sounds really positive, really interesting. I'd like to ask the same question to Warren. What's your outlook and where are you seeing opportunities?
You know, in venture capital, it's important to maintain a healthy sense of optimism. You know, and I think that when you're in this business, you know, the payoffs are very long dated. They take 5 or more years to mature and come to light. You know, the pandemic has put, you know, a variety of things into light, and some of them are positive takeaways. We feel very bright and hopeful that, you know, all the good things are to come. Our strategy is to keep investing thematically into companies that are pioneering in our deep tech space, enterprise, and healthcare. You know, we're working with founders that are focused on the largest propositions that drive significant trend shifts and innovation across industry. It's important to realize that, you know, after any significant market event, like, well, any global event like the pandemic, that there's always technology step change that come after. If you look at the 2008 financial crisis, you saw a variety of fintech boom. You know, a lot of checks and balances, a lot of other financial software that was used to manage risk better, as one example. Well, the pandemic is the biggest opportunities are in the continued growth of the cloud and data, software. You have an interesting statistic right now. The world is swimming in data, bigger than the oceans, and 83% of it is not used, is unoptimized, and is wasted. The pandemic showed us that our disaggregated computing and infrastructure in some core areas that had underinvestment are going to be taking up these technologies with a significant velocity. You know, coming out of this time, it's important to also realize that the nature of work has forever changed. The attitude of going, riding the train every single day, sitting at your desk, going home at 5 o'clock is probably never going to look the same again. So we point ourselves in what does digitization really look like? What is the future of the worker? You know, one of our key thematics is the future of work. It's clear to me that events will be largely digital. Yet it's going to be difficult to imagine that after more than a year of saving expensive travel and entertainment expense and conference fees, that companies are going to want to go back to full-time in person. There's a variety of themes that are stemming from this time, and you know, we just see a very, very solid opportunity set coming out of this.
Thanks very much. Well, really a digital revolution going on, and I think we're all experiencing that by the way we work and the way we live. I'd like to ask David, what's your outlook for the sector and where are you seeing opportunities?
Yeah, well, I'll start by looking back before looking forward. So if that's all right. Venture capital trusts are 25 years old, so they predated the internet, and the fact that they have therefore changed and moved over time, I think is quite instructive to where they might move next. So over that period of time, they've moved from a traditional investment, and particularly across large swathes of the country where it was high-end manufacturing, which then moved into robotics and AI and morphed into those sectors. And as you heard now, the general themes about investing in growth are following the growth sectors, which is clearly about work-related and data management and all the things that hang off that. So those are the areas which are now looking like the growth trends over the coming areas, both in healthcare markets, media creation, creativity, a whole raft of different places. So the result of that, I think, is that you'll see increased deployment throughout all of the chain. Businesses which have got global opportunities and businesses that have got national opportunities. So you'll still get application software, in particular, helping people to work faster, smarter, quicker, better, which might only have a narrower market opportunity, but there's nothing wrong with creating a business which is only worth 20 or 50 or 100 million pounds. You don't always have to be global. And I think one of the attractions for venture capital trusts as a sector is they can appeal across the range of small businesses, with growth opportunities. You can be a global £1 billion business, or you can be a global multi-million, or you can just be a national multi-million pound business. So those opportunities still exist. They're just moving different trends. Currently, you've got the waves that you talked about, which are data, the rise of social media and influencing the way that the corporate pounds are being spent, the way that people are working and working differently, which I think Warren I'd absolutely agree with. That is therefore, there's a whole variety of tools around that. And then also around the ways in which people communicate. So, we invested in a business where I thought it was a piece of technology that was effectively used to protect mobile phones. It's now called a cybersecurity business. It's now developing cybersecurity wrappers for events like this, which didn't exist. So now you've got to have, how is my Zoom call going to be secure in a different way and form? So it's gone through 3 sort of iterations in the 6 years that we've been invested in it. And that's the sort of change that I think you can expect. So I think the outlook for VCTs, I would say, is they always follow the growth pattern. So that it'll be probably different in 5 years to it is tomorrow. Is my guess, which is how it's always been. But I think the big trends and themes that you've seen in terms of where the small businesses are going to follow the growth is where we go as well, which is all of those areas that we've just talked about.
Well, thanks very much, David. I have to say, I think I feel very encouraged having talked to you all. VCT is investing for growth, investing for change, investing to make the world a better place with their ESG implications. I think it sounds very positive. I'd like to thank all our managers very much for joining us today. It's been great to hear their views on VCTs and where they're finding opportunities. I'd like to emphasise that we don't know what's going to happen in the future. Investment is for the long term, and you need to have a well-balanced portfolio. If you're in any doubt, you should talk to a financial advisor. Thanks so much for watching.